Now, this is a question I get quite often, and that is, what trading style is the best fit for divergence trading? Now, we already talked about the market being fractal in nature. So since divergence occurs on all time frames at all degrees of trends, it's great for day trading, short-term trading, medium-term, or even taking longer-term positions. Okay, it's something you're going to see on all levels of the market. Okay, so no matter what time frame you're trying to trade, divergence will work for you. Now, while divergence trading has obvious appeal to counter trend traders, it's normally pushed as a counter trend strategy. All right, it's also very useful for trend trading strategies to help determine if there's a high probability of a continuation. Okay, simply the lack of divergence can give you a high probability of the trend continuing. And you're going to see me use divergence in both situations. While I'm analyzing a chart, we'll obviously talk about divergence setups, but you'll also hear me when I'm talking about the trend. You'll see I'll say something like the price or the market's moved to a new high, but we don't see its divergence, so we'll look for the market to continue. We'll look for a corrective setback and a continuation. This is all what's so very powerful about divergence trading. The dynamic nature of divergence trading and patterns makes it one of the few methods that are great for any trading style. All right, it is truly a scalable trading methodology. All right, so here's an Aussie US dollar chart, and just to show some of the different time frames here. Now you can see here as price was moving to a new high, we had price here moving higher. MACD was starting to cycle lower. Okay, that was giving us a good idea that we were looking for a turn upcoming in the market as we were seeing momentum waning. Now, once we did get the turn, a good target for this trade from a longer term or a medium term perspective would be right around that low at 80.63, and we'll talk about this later. A really good target when we see divergence is, and let me change the template on that. A really good target is what we'll call the divergence target area, and that is the high or the low between the points that diverged. Okay, so that's one thing we'll see, and that's when we're looking at a corrective market. Okay, so this is something that becomes useful when you're drilling down to the small degree time frames, and we'll talk about this a little bit later. I don't want to get too far ahead of us right now. All right, so anyway, but let's look at a little bit closer. So we know we have this divergence. We've marked off that target area. This is on the weekly chart. Now let's look at this swing high right here. Let's just drill into this a little bit. See how we have price moving higher here, MACD swinging lower. Okay, so now we have another divergence that formed and made a really strong move to the downside. Okay, this right here is a very specific setup that we're going to show later on in this course in the application section. Okay, so we would, in this situation, draw our Fibonacci retracements. On the swing, you can see we retraced right here through the 62%. Okay, through the 62% right here, and then we continued on to the downside for another leg. Okay, this is a weekly chart. This is a weekly chart detailing that divergence. Okay, but let's back up a little bit. Let's back up. And let me go ahead and just get rid of these lines so we don't confuse. And let me push this forward just a little bit just to show you. See how the market came all the way back down to target this divergence target area. All right, a really powerful way to look to target trades. And we'll be a little bit more specific with that later on. Okay, but what I want to bring your attention to is right here. Right here. Now, see how we had the market rally. We had a nice strong rally in the market. We're still below this low, but so what are we looking for to happen here? All right, now we see a pullback, all right, a rally and another pullback. So what are we looking at this as a correction? Or are we looking at this as a reversal and a continued move to the downside? One of the things that I would have looked at, now obviously we've taken into consideration some other things, where we're at in the cycle and things like that. But one of the things I would look at was, is there divergence here? And there's not. There's no divergence here. We have price moving higher. We have MACD cycling higher. Okay, there's no divergence there. That would give us a bias of a continued move to the upside. All right, so we would look at this as a corrective cycle. Here we have a 15-minute chart of the same currency, and I just want to kind of go through and just show this. All right, look, price moving higher, MACD cycling lower before a large turn. Okay, continuing over here a bit, we have price moving lower, MACD cycling higher here before a large turn in the market. Again, price moving higher, MACD cycling lower before a large turn in the market. All right, so now let's drill into this particular smaller cycle here. All right, now as you realize, we rallied here, and as we continue to rally, we're not seeing any divergence. So on these pullbacks, that's giving us a good idea to stay with this uptrend. Okay, see all the way up. We rally, no divergence. We rally, no divergence. We rally, no divergence. We rally, then we have divergence. Okay, here is a divergence. Tells us to be a little bit cautious. We see a corrective setback, a little bit of sideways price action. All right, but you can see how the divergence kind of warned us of this upcoming corrective cycle. But before we saw that divergence, we could have stayed with this sharper trend. All right, I just stayed on the same chart here, just on the 15-minute chart, but this, this applies to all your time frames. And, if you're using this on an hourly or a 4-hour chart in this way, that can give you a good idea to gauge the trend when you're looking for some intraday setups on these smaller degree time frames. Here's an example of the same thing on a 4-hour chart. Right now the market has moved down to a new low. We don't have any divergence. We're getting a pullback here. We're getting a pullback. So what are we looking to do? We're looking to stay with the trend. We don't have a divergence. We're looking for another downside move. Okay, and then we have a downside move. Now we're getting some divergence. This is our early warning signal. All right, and even though the market did push down to another low, all right, you can see that we did move into more of a corrective type of a sideways cycle here. Okay, so that's an example of how to use divergence with the trend. The other thing is we're looking at this downside move. The MACD is below the zero line here, so that gives us a downside bias from this 4-hour level. And when we don't see divergence, we're seeing a pullback without that divergence. That gives us a probability of continued downside. Okay, so using divergence really is very dynamic. It works on all time frames. You can use it for counter trend trading, for trend trading, to show you or give you clues as to if you should be staying with the trend, or as an early warning, showing waning momentum, saying that, hey, maybe we want to go ahead and start to protect some profits here. Or then, if you see a divergence and a strong price move, it can give you a counter trend opportunity or a reversal opportunity. Okay, so it really does work for any trading style.